Sarah Borgson-Keto, and in conjunction with NAREIT's REIT Week 2020 Virtual Investor Conference, I'm joined today by video link with Jason Fox, CEO of WP Carey. Jason, welcome.
Thank you, Sarah.
There are a number of ways to approach net lease investing, but WP Carey has always taken a diversified approach. Can you talk about why you believe that this is the best approach to net lease?
Our belief is diversification dates back to the company's founding almost 50 years ago. And we believe it's the best way to build a net lease portfolio for a number of reasons. Number one, it provides a wider opportunity set for external growth. Our ability to invest across property types, industries, and in both the US and Europe, primarily Northern and Western, all widen the funnel for potential investment opportunities. But it also provides downside protection, ensuring that we're not overexposed to a single area of the market, whether that's a particular asset type, industry, or geography. We've also had a long-standing underweight position in retail, and we'd much prefer investing in warehouse and industrial assets. So more so than ever, especially now, the current environment really illustrates the benefits of a diversified approach to net lease. And that's reflected in our strong April and May collections at 96 and 95%. Which is the highest in the net lease sector. So, for us, we also think the COVID-19 impact is really going to serve as a catalyst for investors to refocus and place a higher value on broad diversification and view it as the best approach for net lease. And this is something that we believe to be true for a long time.
Can you describe WP Carey's tenant base, and what is it about your portfolio that makes you one of the few REITs with close to 100% of rent collections?
So strong rent collections start with a strong investment strategy and really a stringent underwriting process. We're a long-term investor. We're focused on creditworthy companies with businesses that we believe will withstand multiple market cycles. We've also been focused on larger companies, which has made a big difference. 97% of our ABR comes from tenants that generate more than $100 million in annual revenues. And this matters because larger companies have institutional balance sheets, better liquidity and access to capital, and in a worst case scenario are more likely to restructure and continue to operate our critical facilities, whereas smaller tenants, they tend to liquidate and disappear. I think it's also important to note that our long-standing underweight position in retail, which makes up only about 17% of our total ABR, including a very minimal exposure to fitness, restaurants, and movie theaters, the sectors in net lease that have impacted the most by the pandemic. That makes up about 2% of our ABR. And our strong preference for warehouse and industrial, that makes up almost half of our ABR at this point in time. Those are important factors in our strong April and May rent collections. And I think unlike some other net lease REITs, we don't sit back and just clip a coupon every month. We have an entire team in regular communication with our tenants, proactively working with them to understand and address their evolving real estate and capital needs, thereby minimizing the likelihood of rent disruptions. And again, this has served us well in the current environment.
Your balance sheet has evolved in recent years. How are you positioned as a result of those efforts?
Yeah, we've made a lot of progress in recent years to enhance the balance sheet. It's positioned us with the liquidity and flexibility needed for really a range of scenarios right now, from weathering an extended economic downturn to potentially taking advantage of new capital allocation opportunities. So right now we're sitting at about $1.7 billion of liquidity on our revolver as of the end of March, limited near-term debt maturities. We have just $110 million of mortgages maturing in 2020, $240 million in 2021, and no bonds coming due until 2023. We're also at the low end of our target leverage ratios and well within any debt covenants at quarter end. Really based on the initial performance of our tenants, printing a sector-leading 95% collection rate for May, in this conservative positioning of our balance sheet, we're confident that we'll continue to have sufficient liquidity and, importantly, flexibility to navigate the environment ahead.
You mentioned that you are well positioned to move quickly on new capital allocation opportunities should they arise. Are there any particular areas in which you expect to see the greatest investment opportunities?
Yeah, we're sitting in a position of strength right now, given our rent collections in April and May, especially relative to our peers, as well as access to liquidity, given our strong balance sheet. So we're actively evaluating opportunities right now. Our team is actively engaged with brokers and other sellers. What we've observed, though, is that transaction volume has been light. I still think that there is a bit of a gap in bid-ask spreads. Sellers still have expectations, perhaps, pre-COVID expectations when a lot of the processes were launched. And I think that over time, we should see some widening of cap rates, especially given the credit environments that would warrant that. I think where the opportunities will come, it's probably not Q2, it's probably the second half of this year where we think we'll be more active. And it's probably going to be more focused on sale-leasebacks, and as a result, likely in industrial and warehouse properties where, companies are looking for ways to either replenish or to provide a cushion in their liquidity. And I think sale-leasebacks are a good opportunity to do that. We're also going to see good opportunities within our existing portfolio. But I think generally speaking, we have seen some of our best opportunities during times of crisis, and we're well positioned to take advantage of that.
Jason, thanks so much for joining me.
Thank you, Sarah. My
Thank
pleasure.
you. And for more news and information on REITs and listed real estate, be sure to visit NAREIT's website, REIT.com.